Welcome back to Curious Commerce, topic fund flow statement, part 9. In this session, we will discuss about the practical examples how the IT company, startup industries, and construction industries practically use the fund flow statements. Retail and manufacturing examples are common, but what about the IT companies? They usually have less inventory, more salaries, and heavy investment in software and technology. So, this session let us understand fund flow in an IT company with a simple real world example. The scenario of IT company: imagine a small IT services company called XYZ Private Limited. At the beginning of the year, the company has working capital of 3 lakh, computer and software systems, some receivables from clients, few short-term liabilities. During the year, several financial activities takes place. Let us track the movement of funds. Major transactions during the year. The first one is the fund from operations. That is the primary source in IT sector. The company earns revenue by providing software services to clients. After adjusting non-cash items, fund from operations is 2 lakh 50,000. For IT companies, this is usually the most important sources of fund because their strength depend on service revenue, client payments, and project efficiency. Strong operating fund indicates a healthy IT business. The second one is the purchase of new computers and software. To upgrade technology, the company purchases the computer and licenses software around the cost of 1,80,000. It leads to the fixed asset increases and funds go out. This is an application of funds. In IT companies, technology upgrades are frequently applicable. The third one is issue of equity shares. To expand into the new market, the company issues shares worth around 1 lakh rupees. It leads to cash comes into the business, share capital increases. This is the sources of fund. Many IT startups depends heavily on equity funding. The fourth one is increase in receivables. Some clients delay payments. As a result, debtors increased by 70,000 and working capital increases. But remember carefully, cash has not yet come. Funds are blocked in receivables. So this becomes an application of fund. Very common risk in IT service companies is the funds are blocked in receivables. Final fund flow summary is sources of fund. Fund from operation is 2 lakh 50. Issue of shares is 1 lakh. The total sources is 3 lakh 50,000 rupees. The applications of fund, purchase of computers and softwares is 1 lakh 80,000. Increase in working capital, that is receivables, that is 1 lakh 70,000. Total application is 3 lakh 50,000. Statement is balanced and correct. In IT companies, management must closely watch client payment details and client payment delays, technology upgrade costs, employee salary commitments, and dependency on equity funding. Efficient fund flow management ensures stable growth in IT business. So, learners, now you clearly understand fund flow in an IT company. Startups are very different from traditional business. They often have limited profit, heavy initial investment, and strong dependence on funding. So, now let us understand fund flow in startup with the simple examples. Just imagine a scenario of startup called ABC, an online delivery platform. At the beginning of the year, the startup has the working capital of 1 lakh, basic software platforms, small team, and minimum liability. During the year, several important financial events happen. Let us track the movement of funds. Major transactions during the year. The first one is the fundraiser from investors, that is the primary source. The startup raises seed funding from investors, amount raised up to 3 lakh rupees. It leads to cash comes into the business, share capital increases. This is the major sources of fund. In most startups, external funding is the lifeline. The second one is the fund from operations, usually small amount. The startup begins operations and earns some service revenue. After adjustment, fund from operations is 40,000 rupees. Early stage startups usually generate limited internal funds. The third one is investment in app development. To, to improve the platform, the company spends 2,20,000 rupees on app development, leads to fixed and intangible asset increase, and funds go out. This is the application of fund. Very common in startups, heavy technology spending. The fourth one is increase in receivables and expenses. Some customers have not paid it and expenses are prepaid. The working capital increases by 1,20,000 rupees. It leads to funds are blocked. This becomes an application of fund. The final fund flow summary is the sources of fund. Investors funding is 3 lakh rupees. Fund from operations is 40,000. The total sources is 3 lakh 40,000 rupees. And the same way, the application of fund, the app development is 2 lakh 20,000 rupees. Increase in working capital is 1 lakh 20,000 rupees. Total application or the application of fund is 3 lakh 40,000 rupees. Statement is balanced and correct. In startups, watch carefully heavy dependence on investors' fund, high technology spending, and slow initial operating funds. Good fund management is critical for startup survival. Construction companies have a very unique financial pattern. They usually face large project cost, advance payments, and long project cycles. So now let us understand fund flow in construction company with simple real world example. The scenario of the construction business. Imagine a construction firm called E&F Constructions. At the beginning of the year, the company has the working capital of 5 lakh, construction equipments, ongoing project work, and some creditors and advances. During the year, several major financial activities takes place. Let us track the movement of funds. The major transactions during the year, the first one is fund from operations. The company completes the part of the building project and earns the revenue after adjustments. The fund from operations is 2 lakh. This shows the company is generating funds from its core construction work. The second one is the purchase of new construction equipment. To handle the bigger projects, a company purchases the new equipment worth around 3 lakh. What happened when the company purchased the new equipment? It leads to fixed asset increases and funds go out. So this is an application of fund. Heavy equipment purchase is common in construction firms. The third one is the long-term loan raised. To finance expansion, the company takes a long-term bank loan of rupees 2,50,000. It leads to cash comes into the business and liability increases. This is the sources of fund. Construction companies often depend on bank finance. fourth one is increase in work in progress. Due to ongoing project, work in progress increases by 1,50,000 rupees. It leads to current asset increase and funds get blocked. This becomes an application of fund, very typical in construction business. Final fund flow summary, the sources of fund from operation is 2 lakh and bank loan raised is 2,50,000 rupees. The total sources of fund is 4,50,000. The application of fund, purchase of equipment is 3 lakh and increased in working capital is 1,50,000 rupees. The total application of fund is 4,50,000. The statement is balanced and correct. In construction companies, the management must carefully monitor work in progress level, heavy equipment investment, dependence on bank loan, and project completion delays. Proper fund flow management ensures project stability and profitability. Let us quickly wrap up what we have learned about the fund flow statement. Now we understood that the fund flow statement is not just a theoretical statement, it is a powerful financial analysis tool. It helps us clearly answer three important questions. From where did the funds come? Where were the funds used? And how did working capital change? We also learned the complete process. First, prepare the schedule of changes in working capital. Secondly, calculate the fund from operations. Finally, prepare the fund flow statement. Through examples from retail, manufacturing, IT, startup, and construction industries, we saw one important truth: every business survives on proper fund management. A company may show profit, but without proper fund flow, it may still face financial stress. That is why managers, investors, and banks carefully study the fund flow statement before making decisions. Remember this golden lines: profit shows performance, fund flow shows financial movement, cash flow shows the liquidity. A smart financial analyst always looks at the three golden lines. Profit shows performance, fund flow shows financial movement, cash flow shows the liquidity. If this entire fund flow series helps you understand the topic clearly, like this video, share with your friends, and subscribe to Curious Commerce, because here commerce becomes simple, practical, and powerful. See you in the next video.